Good morning and welcome to T-Hub Capital, the Investors Lounge, the podcast where we explore financial market dynamics, emerging trends, and the insights that shape successful investments. Each week, we'll delve into the strategies and analyses that drive our investment decisions. You'll get an insider's perspective on the factors influencing markets and the potential winners and losers of tomorrow. Subscribe to the podcast to stay ahead of the curve and make informed investment choices. Enjoy listening.
Welcome to T-Hub Capital's The Investors Lounge weekly podcast. Today's date is the 15th of June. Let's dive into the week's top market news. Monetary shifts and macroeconomic crosswinds. Navigating European market dynamics. The Pan-European Stocks Europe 600 Index concluded a highly volatile weekly session with a net gain of 1.69% in local currency terms. Prior to this positive finish, continental equity markets experienced a mixed performance as investors braced themselves for the highly anticipated interest rate decision by the European Central Bank. Global market sentiment was further complicated by lingering geopolitical tensions, driven primarily by reciprocal military strikes conducted between the United States and Iran. However, a wave of late-week optimism regarding a potential peace agreement ultimately revitalized investor confidence and triggered a widespread equity rebound. Performance across major national indices clearly reflected this fragmented environment, with Germany's DAX closing 0.50% lower, while France's CAC 40 index climbed 1.61%. Italy's FTSE/MIB rallied significantly by 3.22%, and the UK's FTSE 100 index posted a modest advance of 1.00%. The European Central Bank returns to tightening. In a landmark move that perfectly matched consensus expectations, the European Central Bank implemented an interest rate hike across three of its key rates, marking its first upward monetary policy adjustment since September 2023. The Governing Council explicitly warned that the broader economic outlook remains fundamentally uncertain, characterized by persistent upside risks to inflation and notable downside risks threatening overall growth. Central bank officials emphasized that the exact intensity, duration, and indirect downstream effects of the recent energy price shocks remain largely unpredictable variables. Alongside this monetary tightening, the central bank updated its medium-term macroeconomic forecasts, revealing that headline inflation in the Eurozone is now projected to average 3.0% in 2026, 2.3% in 2027, and finally hit its target equilibrium of 2.0% in 2028. Concurrently, the bloc's economic growth forecasts were revised downward, with gross domestic product expected to expand by a mere 0.8% in 2026 and 1.2% in 2027. Divergent industrial and inflationary trajectories. On a regional level, domestic economic indicators across major European powers painted a vivid picture of structural divergence. In Germany, industrial production provided a minor positive surprise by rising 0.4% month-over-month in April, which aligned with market expectations and marked a visible recovery from the 0.1% contraction recorded in March. This modest industrial expansion was heavily supported by robust activity within the construction, chemical, and fabricated metals sectors, though the critical automotive industry continued to struggle, suffering a sharp 4.7% decline in production. Meanwhile, consumer prices in the Netherlands hit a significant headline inflation rate of 3.5% year-over-year in May, up sharply from the 2.8% recorded in April and landing noticeably higher than the broader Eurozone average of 3.2%. Statistics Netherlands attributed this aggressive acceleration primarily to a steep spike in air travel pricing. In a similar vein, France saw its annual inflation rate edge up to 2.4% in May from 2.2% in April, driven to its highest level since February 2024 by elevated energy costs. UK contraction and the implication for valuations. Across the English Channel, The United Kingdom faced an unexpected macroeconomic hurdle as its gross domestic product contracted by 0.1% month-over-month in April, a sharp reversal from the 0.3% growth expansion experienced in March. The primary driver behind this contraction was a widespread slowdown across the services sector, which managed to completely couch the ongoing expansion observed in the information and communications sector. This cooling economic data has heavily reinforced market expectations that the Bank of England will choose to leave interest rates unchanged during its upcoming monetary policy meeting on June 18. On a brighter note, the UK's overall trade deficit managed to contract to £8.44 billion in April, a positive shift that was spearheaded by a robust surge in outbound goods exports. Now our insight into alternative markets. Continuation vehicles. The structural turning point of private equity in 2026. The private equity secondary market is undergoing a profound and likely irreversible transformation. While LPs express growing skepticism about the returns offered by LP-led secondary sales, enthusiasm for continuation vehicles, CVs, particularly single-asset funds, has reached unprecedented levels. This is not a cyclical phenomenon. It is a rewriting of the rules of the game. The context: scarce liquidity, stalled markets. The primary private equity market has been caught in a difficult grip for years. IPO exits are almost entirely blocked. M&A activity is proceeding at a reduced pace, and distributions to funds have hit historic lows. Against this backdrop, the secondary market has exploded as the primary pressure valve for investors. In 2025, the global secondary market reached an estimated record value of $225 billion, with 86% of market participants expecting new highs in 2026. According to Houlihan Lokey, the main drivers are the lack of liquidity for institutional investors, the absence of traditional exit routes, and the influx of new capital from evergreen funds and retail investors. A market, in short, that has ceased to be an exception and has become standard architecture within global private equity. LP-led secondaries, returns under scrutiny. LP-led transactions, whereby existing investors sell fund stakes on the secondary market, have historically represented the majority component of secondary activity. In 2025, they reached $110 minus $120 billion, accounting for 54% of total volume. However, a growing proportion of LPs is expressing increasing skepticism. More than 4 out of 5 LPs investing in this segment target multiples of between 1.5x and 1.75x on invested capital, a target that remains well below the 2x or more that represents the classic benchmark of primary private equity. Adding to the concern, in the second half of 2025, more than a quarter of LP-led transactions closed below 80% of NAV, a sign that selling under conditions of urgency still significantly penalizes the seller. The logic is straightforward. Buyers in the secondary market are well aware of their negotiating power in a market where the demand for liquidity frequently outpaces the supply of patient capital. Continuation vehicles, the GP-led comeback. It is precisely in this context that continuation vehicles are winning the confidence of LPs as active investment instruments. Structured by general partners to transfer selected assets from a maturing fund into a new dedicated vehicle, CVs allow high-quality assets to be held for longer without forcing a discounted sale on the open market. The volume of single-asset continuation vehicles, SACVs, surged 76% year-on-year, reaching $60 billion in 2025, up from $34 billion in 2024. The CAGR since 2018 is close to 35%, and nearly 1 in 5 exits in the global PE market in the first half of 2025 took place via a continuation fund. Return expectations across the various secondary instruments reveal a very clear hierarchy. LP-led transactions, by their nature diversified and with a shorter hold horizon, settle at target multiples of 1.5x-1.75x. Multi-asset GP-led CVs, on the other hand, target multiples of 2.0x or above. More than 67% of investors in this segment declare this as their minimum objective. The further step up comes with single-asset GP-led structures, where more than 90% of investors target multiples of between 2.0x and 2.5x or higher, accepting elevated concentration in exchange for direct exposure to so-called trophy assets, the best assets in the GP's portfolio, with an already established track record and still unexpressed growth potential. Why CVs outperform traditional buyouts? The empirical performance data becomes even more compelling when compared against traditional buyouts. According to HarborVest, continuation funds have outperformed buyouts in every quartile over the past 5 years, with a loss ratio of 9% against 19% for buyouts. The median net IRR stands at around 19 to 21%, with a median TVPI of approximately 1.42x. The underlying logic is sound. The GP already has deep knowledge of the asset after years of management. There is no blind pool risk, and no turnaround phase is required. It is simply a matter of extending the hold on what is already working, with the awareness and discipline of someone who has already built the value. Warning signs for LPs. Not everything is straightforward, however. The term trophy asset has no standardized definition, and LPs must remain rigorous in their due diligence before deciding to roll over into a CV rather than taking cash. The first question to ask is whether the asset is genuinely the best in the portfolio or simply the least problematic among those remaining. The second concerns market interest. If the asset is truly exceptional, why are no competing third-party buyers emerging during the process? The conflict of interest is structural. The GP is essentially selling to itself, and the governance of the process must be examined with rigor. For this reason, nearly 90% of investors now require GP commitments considerably above 5% of the deal to ensure the so-called skin in the game and genuine alignment of interests. This is no minor detail. 25% of LPs believe that GP-led transactions are carried out for the right reasons only about half the time. A warning signal that serves as a reminder that analytical capability remains the true competitive differentiator for those investing in this market. The 2026 market. Structural, not cyclical. The forces that have driven the explosion of CVs, blocked exit markets, liquidity pressure, funds in overhold, are not temporary. 96% of secondary market operators expect GP-led pricing to remain stable or increase in 2026, and not a single participant in the Houlihan-Lokey survey anticipates a significant price decline. The most attractive sectors for secondary investors in 2026 are business services, technology, healthcare, and industrials, all areas where value creation over time rewards those with the patience to wait. For private equity professionals, the message is clear. Continuation vehicles are no longer a niche solution adopted in the absence of better alternatives, but are becoming a structural component of the liquidity and exit architecture of global private equity. The ability to assess the genuine quality of the underlying asset, evaluate GP alignment, and negotiate rollover terms with precision is today a defining competence for those seeking to capture the superior returns these instruments can offer, without falling into the traps of adverse selection. In a market where liquidity is the true currency of exchange, CVs represent, when carefully selected, one of the most compelling opportunities of the current private equity cycle.
Thank you for listening to this episode of T-Hub Capital, the Investors Lounge podcast. I hope you found this content interesting and inspiring. If you enjoyed this episode, don't forget to subscribe to the podcast so you don't miss a single episode, and share it with your friends and colleagues who might be interested. To learn more about T-Hub Capital and our activities, visit our website, thubcapital.com. You can also follow us on our LinkedIn page. See you soon. All the best from the T-Hub Capital team.